Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Niehaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Hi. This third episode of Total Convexity is being recorded on October the 13th, 2023. I'm your host, Henrik Niehaus. Joining me is my co-host, Jim Wang. I'm glad to return to this third episode of our podcast. In the first episode, we discussed our investment framework and analytical framework. We recommend new listeners to review the first episode first, because that will lay the foundation for the future episodes. In the second episode, we discussed interest rates and treasuries and concluded that the recent sell-off of treasury securities represents a buying opportunity for investors. In today's episode, we thought it would be helpful to discuss the US dollar. Jim, what do you think?
Yeah, sure. That's a great idea.
For macro investors like you, currencies are one of the more impactful tools for you with which to express your views. For multinational corporations, managing currency exposures is one of the important functions of the Treasury departments. Asset allocators and domestic investors, however, do not seem to pay much attention to currencies, in my opinion, other than helping them making hedging decisions on overseas investments. You, however, Jim, think that understanding currency markets and the US dollar cycle is very helpful, even for long-term asset allocators. Could you expand on that?
Yeah, sure. So because US dollar has a very special status in the international, currency market, which is reserve currency. So because of that, the US dollar cycle is very important for different asset classes. And obviously, the currency movement against each other also are very important. But most of the world trade transactions are denominated in US dollars. Commodities are denominated in US dollars. Financial transactions are denominated in US dollars. And the reserve currencies are mostly held in US dollars. Therefore, the overall liquidity of the US dollars will drive the asset class, economic performance, and also the overall performance of a financial asset. In addition, the US dollar, the relative strength of US dollar against the other currencies also will determine the relative performance of different asset classes. Finally, currency sometimes can also offer us leading indicators of the real economic development in some countries. And that will help allocators to understand what's going on in that country. For example, we have talked about, in the recent U.S. Hiking cycle, where U.S. dollar have significantly outperformed the rest of the world, with the exception of Mexico. I mean, you will be very surprised. The Mexico currency actually was stronger than the U.S. dollars. since the U.S. started tightening the monetary policy or hiking the interest rate in the past 2 years. And we talk about, you and I have discussed in the past, and I think there is a quietly secular shift, behind the scene that explains that. And we can talk, that's a side topic. We can talk a lot on that in the future on that episode. And finally, I also think that, when we talk about currency, we're talking about fiat currency, right? One currency versus the other. And I also consider gold as a currency. And understanding the fiat currency, the drivers behind them, and it will help understand the role of gold in the portfolio construction, both as a technical play or a strategic play, which we think that in the future, it can really become a strategic part of the portfolio. And so I think understanding the currency is really important, especially understanding the US dollar cycle.
Right. Now, I believe that one reason many asset allocators neglect the currency markets is that they think that the currency markets are notoriously difficult for getting right directionally in the short perspective. Do you agree?
I completely agree, especially when you mention in the short term, because the currency market, there are so many players in the currency market, right? There are people who need to do international trade, so need to settle the trade. And also, foreign direct investment in different countries. And there's also portfolio flows. At the same time, there's a hedging transactions for multinational companies. And obviously, there are speculators who are trying to make money out of this. And a lot of currency, traders are short-term in nature. So therefore, it's very noisy, and it's not easy to get a directional right, day to day, hour to hour. However, the currency market actually really have fundamental drivers, and if you think about it, it's really supply and demand for a specific currency. And if a country run a surplus, meaning you export more and import less, naturally there will be demand for your own currency in the long run. At the same time, you also have a capital flow where, there's be foreign direct investment, find, interesting, attractive investment opportunities, long-term investment opportunity in a particular country. So there will be increase of foreign direct investment. At the same time, the portfolio flow also is an important part of the supply and the demand. And a lot of time that is driven by the real interest rate differential. In other words, the currency will seek higher interest rate after inflation. So those are the fundamental drivers in the long run that would drive the relative performance of the currency. And obviously, from our perspective here, because of the unique role of US dollar, the US dollar cycle really is really important for the long term, even for the long term asset allocators, and also domestic investors, even though they do not trade currencies. And so, should we talk about US dollar cycle then?
Sure, absolutely.
Okay, so, well, most people are familiar with economic cycle, right? So they are now less familiar with the US dollar cycle. But actually, US dollar also follow distinct cycles. So I have prepared a presentation chart here. Let me just flip to the first page here. So let's just look at the most recent examples here. So when this is from 2020 to the current time period, the top panel is US dollar. The panel in the middle is the total return ratio of S&P 500 to MSCI EFA, meaning to the non-US developed market. And the lower panel is the total return ratio of S&P 500 to MSCI emerging market. Okay, so if you look at them, they're almost, the same chart. As we know, Fed hiked the interest rate in the past 2 years, and that's the key driver for the US dollar went significantly higher, all the way to October 2022. And then we have a temporary drop of the interest rate, and the US dollar weakened a little bit. And during that time period, when the US dollar was strengthening, as you can see, the US S&P 500 was outperforming the non-US DM market and EM market from October to March, right? And for the brief time period when the US dollar was declining and the US asset was underperforming Europe and underperforming emerging market. Until recently, the US dollar strengthening again, and the US equity market have started outperforming developed market and emerging market again. And if we look beyond a little bit longer horizon, it's actually the same thing. So let's zoom out and let's talk about the US dollar cycle. So in our framework, we have three distinct US dollar cycle. So one US dollar cycle we define as easing cycle followed by a high tightening cycle, okay? So you can see from the 1960s, 70s, right? All the way down to 1980s, that's the easing cycle. 1980 and towards to the mid of 1980s, and that's a tightening cycle. And then all the way down to the the mid of 1990s, and that is a falling cycle, and then it's rising cycle again after that, during the peak bubble. So that's the second US dollar cycle. And the third US dollar cycle was starting from burst of tech bubble, and it became US dollar was falling all the way down to financial crisis. And then we followed by a rising US dollar since the burst of financial crisis all the way up to right now. And we think that we are towards the end of this US dollar cycle. Now, it still have some room to run. This is a very long term. So we are saying we're towards the end of it. Still there is a horizon of maybe 8 to 12 months. And we will talk about more details in this during this transition period. So, it's useful to review the history. In 1971, Nixon announced the depeg of US dollars from gold, right? Effectively ending the Bretton Woods monetary system post the World War II. And after that, US dollar have a significant decline. As you can see, US dollar declined from, indeed the US dollar index declined from 120 all the way to 90. That's 30% of decline, from the beginning from 1971 all the way, down to the 1980, right? So during that time period, Latin American countries take off, okay? And that is a Brazilian economic miracle. Even during the military dictatorship, and the Brazilian economy was growing 10%, per annum in the early 1970s. So they gained a nickname of Latin American economic miracle. Then it came in and then as you know, during that time period, in the US, we had a very high inflation, and then Volcker hiked interest rate to 20%, right? First in 1980, and then again in May 1981, and that really killed inflation. And so, after the significant tightening of the interest rate, and after they killed inflation, the real interest rate in the United States has gone up a lot, and that pushed up the US dollar. That's pushed up the US dollar higher, starting from 1980s, right, all the way to 1985. It has gone from 90 to 150, right? So like three quarters of the increase, right? And what happened? It was the birth of Latin America economic miracle, right? So it's the lost decade for Latin America and for Brazil. So as you can see, this easing and the falling and the rising U.S. dollar is associated with the boom and bust of the other non-U.S. economy, especially is the emerging market. Now, in 1985, we had a Plaza Accord, and during that time, because not only emerging market was Latin America was booming, and the Japanese was gaining significant market share, and so was Germany. So the U.S. was running large, a trade deficit. So they had a Plaza Accord and forcing U.S. dollar to depreciate within less than 2 years, right? As you can see from chart, U.S. dollar index fell from 150 all the way down to 90, right? Back to 90 again, and that's the second kind of U.S. dollar cycle start. And during that time, what was booming? It was the Asian tigers, right? So during that time, Singapore, Taiwan, Thailand, Malaysia, and all these countries were starting to take off. Now, all those good days ended, not because of a lot of theories and the people were created for them, but rather Alan Greenspan started raising the interest rate from 3% to 6% in 1994, right? And that caused the bond massacre. And by the way, the magnitude that we have, the magnitude of sell-off during that time, although it was called the bond massacre, is nothing like today. Okay, and during that time, you probably heard. I don't know. Were you still with the Solomon Brothers? It was 1994, right? Orange County went bust, right? So you probably heard about those, those stories. And after that, you just have So then you come the U.S. dollar rising cycle, right? From 1994, all the way to the tech bubble, U.S. dollar was rising, and that is associated with a series of financial crises, right? So first we talk about the bond massacre, Orange County went bankrupt, and you have Asian financial crisis during that time, right? All the Asian currencies start with bust, and then the contagion went to Latin America, and then later on went to Russia, and then long-term capital went bust, right? Although during the time, Alan Greenspan said, this is an irrational exuberance, but that did not prevent him from cutting the interest rate after the debacle of long-term capital. So Fed cut interest rate in the second half of 1998, and then later on the Fed raised the interest rate from in the 1999 to 2000, and that basically resulted in the end of the rising market cycle, and started initiated the tech bubble, right? So during this time period, right, there is a significant outperformance of the emerging market, right? As you can see, and then obviously after the U.S. dollar rising cycle, and the U.S. assets started outperforming significantly again. Now, the third U.S. dollar cycle really started after the tech bubble. So Fed lowered interest rate aggressively after the burst of the tech bubble, and that resulted in the falling U.S. dollars. And the falling U.S. dollars resulted in, guess what? Boom, again, overseas, and especially in the emerging market. And as you can see, from 2000 into the financial from 2000, 2001, 2002, and all the way to the 2003, U.S. asset significantly underperformed non-U.S. asset, especially relatively emerging market, and that is the golden age of emerging market. And guess who came out of that? It was China, right? China became the economic miracle. And during this time period, there's the U.S. dollar was depreciating significantly, and obviously China also benefited from the timing was also perfect. They just joined the WTO during that time period. So then we came the rising dollar cycle, and that I would argue that really started in 2011. Okay. Although U.S. dollar, you can see here, it bottomed out in 2009 and 2008 actually. So, but the real U.S. dollar rising cycle really started in 2011, and then that marked the significant outperformance of the U.S. asset versus the rest of the world, especially against the emerging market until today. So as you can see, that understanding the U.S. dollar cycle is very important, and not only from currency perspective, but also from the global asset allocation perspective, in the sense that rising and falling U.S. dollar was driving boom and bust of the global economic cycle, and obviously also drive the relative performance between the U.S. asset and the rest of the world. And from that perspective, I think that we are towards the end of this rising U.S. dollar cycle, started in 2011, and coming to the end of this dollar cycle. And in the later on, I think we can touch upon how this transition from the rising U.S. dollar to the falling U.S. dollar would play out.
Right. Well, Jim, thank you. Well, thank you very much. That was a very powerful overview, actually. Yes. So it's very clear that having a good grasp of the U.S. dollar cycle is important for global investors, even if you don't make explicit currency bets. It's all incorporated. Now, however, how would you make use of these insights, even if your investment mandate were to be purely domestic? Say that you run a domestic U.S. Equity mandate or something.
Yeah. So obviously, I think implications for global asset allocators are obvious, right? And if your investment universe is domestically driven, and I think it is still very useful. First of all, I think it's the overall level of U.S. dollar. It reflects the U.S. dollar liquidity. So therefore, most of the cases with the U.S. dollar depreciating, that is conducive for the higher financial asset. And thinking also, you can think about that is because the financial assets are denominated in U.S. dollars. So if the denominator was coming down, then the overall ratio would go higher. I think that's the first implication. And therefore, you want to invest in financial asset when the U.S. dollar was falling, and even its domestic asset. And the second implication is that because of the rising U.S. dollar, because the U.S. dollar is very important for the global trade. So therefore, it will create a discrepancy between different sectors that will benefit from this and sectors that would not benefit from this. Say, for example, if you are importing a lot of materials into the U.S. And your cost would increase higher, and that is going to hurt you. And conversely, if you export and the falling U.S. dollars may help your competitiveness. So I think therefore it's important for the security selection purpose as well. And as you know, a lot of financial analysts, when they analyze the company's balance, company's revenues and the profitabilities, and a lot of time they do not take into the currency effect. But in the end, actually, currency effect explain significantly profitability of companies, right? Do you agree, Henrik?
No, absolutely. So, okay, so we know the dollar is important, obviously, and we have a fundamental analytical framework really for navigating and understanding the dollar cycle. So, given that, Could you talk a little bit about where in the dollar cycle we are right now, and where you think we're going in the next few years?
Yeah. So I think I talked with this at the very beginning. Like during our previous conversation, I say, I already said we are towards the tail of this rising US dollar cycle, and we are about to end the next dollar cycle, which will come down. And obviously there will be transition period. And why I'm saying this? And this is because the US dollar cycle also follow a certain pattern. And obviously the US dollar cycle, first of all, is driven by the US monetary policy. And when you have a higher interest rate, especially higher real interest rate, money will come to the United States, versus the rest of the world. And the higher real interest rate is typically driven by strong economy, and especially is driven by productivity, right? So the chart I show here is the U.S. dollar index on the top, and the Fed fund rate at the bottom. Okay, as you can see, the falling U.S. dollar and the rising U.S. dollar is closely related to the hiking cycle and easing cycle. Obviously, they will have a little of time lag. That's because typically the U.S. dollar cycle, the U.S. dollar will sniff out the expected Federal Reserve monetary policy, and they may move a little bit earlier. And the lagging, how far they will move earlier, it can be a few quarters, right, to a little bit more than that. So if you look at that, we can look at the last cycle. Say for example, as you can see from burst of tech bubble, right? The Federal Reserve cut interest rate all the way down to was 1.5%, right? And U.S. dollar was falling on that, right? From 2004 to 2005, so the U.S. dollar was rising, and that's because 2003, right? Because the Fed was aggressively, raising the interest rate, right? Although from, the Fed continued to raise interest rate in 2006, and the U.S. dollar already started to fall, right, during that time period. And there was in anticipation of a Fed pause, and the Fed did pause, right? And then Fed started to cut interest rate, and the U.S. dollar continued to fall, right? And recently, if you look at the recent kind of, more kind of acceleration of the U.S. dollars, from 2016 to towards the end of 2018, right? U.S. dollar was rising, and most recent is an example, right? From 2022, 2021, right? End of in 2022, we had a very aggressive hiking interest rate hike, and therefore the U.S. dollar was accelerating to the upside. So if you really look at the history, right, and if you look at previous time period, you can see it's really the same thing, right? So the U.S. dollar cycle is closely related to the interest rate cycle, and you can say that with a different with a little bit of lag, not lag, actually is a little bit forward, where the U.S. dollar is anticipating the hiking cycle or the easing cycle of monetary policy of the Federal Reserve, and where when you have a tightening cycle, the U.S. dollar typically will rise. When you have an easing cycle, the U.S. dollar will fall. And because we think that we're towards the end of the hiking cycle, and that's the key reason that we think we're towards the end of rising U.S. dollars, right? Obviously, the U.S. dollar, we're obviously, when we talk about the U.S. dollar versus the rest of the other currency, you got to understand the U.S. monetary policy against the other countries, right? Fortunately, because the U.S. economies. Economic growth is really the engine of the growth of the whole world, and because of the unique, characteristic of U.S. dollars, where U.S. Federal Reserve typically lead the monetary policy. So when the Fed typically is the one start to hike interest rate and the cut interest rate versus the global economy. Obviously, we cannot generalize. From time to time, there's also kind of divergence between the different countries, right? So I think this one will be interesting to explain a little bit about where we are, kind of in terms of U.S. dollar cycle by just looking back, the past kind of, in our current U.S. dollar rising time period. So if you can see here during this time period, right? So this is basically on the top is your U.S. dollar versus a 10-year kind of real interest rate differential between U.S. dollar minus European 10-year real interest rate. So real interest rate is defined as a nominal interest rate minus inflation, right? So we know the Fed start, the cutting interest rate down to zero in 2008, and really the hiking really started in 2016, right? But in between, the U.S. dollar has started rising, and in between, you can see is really driven by the interest. It can be explained by the interest rate differentials between the U.S. and versus Europe. As you remember that after so when I say the rising U.S. dollar really started in 2011, and I think the key thing was during that time. First of all, before that, I would say once you cut the interest rate to zero, and Fed essentially easing the monetary conditions using QE. So every time you conduct QE, basically U.S. dollar fall, you stopped QE, and then U.S. dollar started to rise again. I think 2011 is a key point of the monetary divergency because first you have the Abenomic, in 2012 you have Abenomic coming in, and from 2012 to 2014, Japanese yen have a significant depreciation, right? And that's the time that U.S. dollar was started significant rising. And I use European kind of interest rate differential here is because Europe is the biggest component of the U.S. dollar index. But if you graph this versus Japanese yen, graph this is 10-year U.S. interest rate versus Japanese interest rate. And U.S. interest rate was significantly higher than Japanese interest rate because of the Abenomic in Japan, because of the QE in Japan. And then after that, in 2014, as we know, the ECB started the QE, right? And you can see the real differential from 2014 onward start to accelerate to the upside, and the U.S. dollar start to accelerate significantly to the upside, right? So that's the second, that was the key driver for the rise in U.S. dollars. It was really because of the easing, first in Japan and then ECB, and then at the same time, the U.S. started tapering. If you recall, U.S. started tapering monetary policy in 2014. So that's why I say the U.S. dollar rising cycle really started from 2011, and that was explained by a rather more tightened monetary policies in the United States, then Europe, and then in Japan. And so obviously, I think is from the big picture perspective, it's easy to say that rising, kind of a tightening monetary policy in the United States, especially against the other countries, major countries, will drive the U.S. dollars, Okay, and in the current status, if you can look at Japan, really they are stuck at a zero interest rate. They cannot raise the interest rate even they want to, and that's a special case which we can talk about on that. And in Europe, we see there's a temporarily, temporary increase of economic activities. I would say last year, because of the stimulus they handed out to deal with the energy crisis, right? And that explains partially the euros was slightly stronger than the United States starting from October all the way to the Q1 this year. But if you look at this, I would say the transition period also is very important, right? So typically, I think I use the previous cycle as an example, but if you look at tech bubble, and time period is very similar. So I have a 3-panel here. On the top is US dollar, in the middle is high yield spread, and at the bottom is US Treasury 2-year rate. High yield spread is more kind of indication of the risk for the risky asset, which is a credit and equity. When the high yield spread goes higher, and typically the risk asset goes down. And the 2-year Treasury is typically an indication of the short-term monetary policy, right? And then you have US dollar on the top. So if you look at the 2003, right, Fed started raising interest rate, 2-year interest start to rise, and that's the time US dollar start to rise, right? And like I said, in anticipation of easing, in anticipation of pausing of monetary policy, US dollar actually start to fall in 2005, 2006, okay, and start to falling. Now, during the 2008, right, although if you look at this graph, although the 2-year interest rate continued to fall, right, US dollar actually was rising from 2008 to 2009, and that's because we have the subprime crisis. So US dollar also have another property, which is safe haven. So this can be explained, a lot of people explain this as a kind of a dollar smile. Meaning when the US economy was doing very well and the Fed was tightening monetary policy, and therefore the Fed was able to tighten monetary policy, then the rest of the world, and that is the time the US dollar is very strong. And once the Fed tightened the monetary policy conditions long enough, tight enough, until something break, and then during that period of time, when the things are breaking, that's the second time the US dollar will rise, and that's driven by flight to safety. And once those things is broken, and the Fed came in and aggressively easing the monetary policy, that's the time we will have the US dollar falling cycle, the start of the falling US dollar cycle. And I think the history probably will say this will probably repeat again, right? And let's see. I think here this chart is not very is not very clear. This is also you can see this, right? Because we have a rising interest rate from 2016 to 2018, all right, and the US dollar was rising, right? And after 2 years actually was starting to fall before Fed kind of start to cut interest rate, right? In 2019, Fed, Powell have a pivot, right? And after the S&P 500 had a big decline, fast forward to 20, during the pandemic, right? And although Fed was cutting interest rate back to zero again, and the US dollar actually was rising. for a short period of time until for a short period of time until it realized that the Fed has done enough, and monetary, there is also fiscal easing. So basically, both fiscal authority and the monetary authority have done enough to contain the crisis, and during that time, U.S. dollar started to fall, right? And this recent rising of U.S. dollar, as we say, is really driven by the fast, the most drastic tightening monetary policy, as we have discussed, and then I would say this cycle probably will follow the same. One can say here is that October last year, that may be the peak of the U.S. dollar, because that basically in the market sense that, and especially in March this year, right? The market sense that the monetary policy obviously is tight enough, and there's not much you can go higher. But however, you can stay for longer to break things, right? So I think the U.S. dollar, you can use the last October high as a reference point where that could be the peaking point. When I say could be a peaking point, can we take a look at that previous peak again? Yes, possible. And that especially will really depend on the risk. I would say we will come another leg. So the first leg is driven by tightening monetary policy in the United States. I think that is happening right now. That has happened, and that's still happening right now. And especially, I think the rising U.S. dollar was really driven by two things. And basically, one is market reprice for interest rate to higher for longer, right? So reprice for the tighter monetary policy. At the same time, it is obvious the European economic growth was falling, right? And Europe cannot tighten the monetary policy as people were expecting. So you put these two things together, that has resulted in the recent rise of the U.S. dollar. How high can this go? I say, it can continue to go a little bit higher. However, they may have a brief period of pause. I would say the next major move is not going to be driven by the tightened monetary policy, but rather is going to be driven by risk off. In other words, the tightened monetary policies and will result in the next down cycle, and probably will result in a severe sell-off of risk asset. And during that time period, U.S. dollar probably will have the final leg of rally. Now, how much that rally will be, and how long will that last? It will really depend how Fed come in here to ease the monetary condition in reaction to the asset prices decline. And I would argue, and this time can run a little bit longer. In other words, because of the high inflation, it will really require things to really, really go down a lot. In other words, unemployment really have to accelerate to the upside, and at the same time, the financial asset price really need to have a drastic decline in terms of speed and the magnitude for the Fed to take action. So therefore, you can argue the last leg of the U.S. dollar kind of rise during the safe haven, flight to safety that time period can last a little bit longer than normal time period. So after that, and I would say the Fed will come in here and will start aggressively easing monetary policy. Then I will think that it will mark the start of the next U.S. dollar cycle. Okay, and what's the implication for the global asset classes? And I just shared that chart. The falling U.S. dollars will create a global boom, and this time pick your favorite EM countries And I would say, I mentioned, will be those countries who are going to benefit from the delinkage of the supply chain to China. Okay, so those will be India, and especially Latin America, Mexico, and the Latin American countries. So I will not be surprised. So in the next 5-10 years, right, we will have another economic miracle coming out of those countries, and that will coincide with the start of the U.S. easing U.S. dollar cycle, the next U.S. dollar cycle, which I think is going to start within 1 to 2 years. However, in the next, I don't know how long, a few quarters, maybe to 1 year, and maybe 12 months, maybe 15 months, and during this transition period, and I think the U.S. dollar can still go higher, as a safe haven demand. Maybe can come as soon as the next few quarters, right? And I think this is the time. I think the U.S., the monetary condition is tight enough to break things, and I think the accident can happen anytime in the future. So to summarize, it's basically we think we are towards the end of rising U.S. dollar cycle that started in 2011, and will enter the transition phase from the rising U.S. dollar rising U.S. dollar period into the next dollar cycle. And during the transition period, and typically the U.S. dollar will have the last leg of rally during the risk of environment as a safe to quality play. And then after Fed aggressively easing the monetary policy, once the market deemed that the easing measures are sufficient enough, then the U.S. dollar will fall. And that will mark the end of the rising cycle, the beginning of the next cycle.
Wow, that was a lot. Thank you very much. Well, and then of course, let's see what happens with geopolitics. It could really bring some surprises. Now, the fact that the US dollar is the dominant reserve currency clearly is an integral component of the US dollar cycle. However, recently, I'm sure we all have seen news, seen the headlines, heard the pundits talk about the US dollar gradually losing its dominance as a reserve currency. We have China and Russia very publicly talking about this, and joined in by the rest of the BRICS and some wannabe BRICS. And are trying to come up with alternatives to use their currencies or some combination of their currencies to settle global trades. So China, for example, is actively promoting its currency for international trade settlements. So, Jim, do you worry that the US will actually lose its dominance as a reserve currency? And what do you think might be the timeline for this transition? And if so, how would this impact the dollar cycle?
Yeah. So, Henrik, I have learned to stop worrying about anything. So I'm not worried about the things that I cannot control. So I do not worry that U.S. will lose the reserve currency status. However, I do think this is a very interesting topic and is widely discussed by the medias and by the pundits. What I can say here is that it's unlikely the U.S. dollar will lose its reserve currency status within the time period that you and I invest right now. However, from a long-term trend, the trend is not favorable, and the reason for that is because of the unsustainable nature of the fiscal situation in the United States, where you really need to have natural buyers. You really need to have buyers to come in and buy the newly increased fiscal kind of debt securities as a result of the fiscal deficit. Otherwise, you have to monetize your own currency. As a reserve currency, you feel you can monetize your own debt as Fed has been to QE without much consequences, right? But this can only buy you time, and things can change too. I mean, you can have the other emerging countries like India and etc., and then they can still rise, and they will partially fund it. But in the end, the U.S. fiscal situation is just not sustainable, and that will erode fiscal dominant, kind of the U.S. reserve currency. Interesting. I read an article and I forgot who wrote this, so I do want to credit the author, but I forgot who wrote this article. But basically, they have interesting things about these interest expenses versus the defense. Once your expense on the interest of your debt exceed your defense budget, and that's the indication of the fall of, of the empire, and that applied to Roman Empire, and also to Great Britain as well. So from that perspective, it's not the sign. But I would say China and Russia and all these great countries, although they are trying to basically replace the U.S. dollars, but it's going to be very hard and it's going to take a long time. And the reason for that is because they can use them as a transactional currency. However, transactional currency is different than the reserve currency. So the other countries, once they get Chinese renminbis, right, they have to convert into U.S. dollars to buy treasury, because there's no way they will go there and buy the Chinese debt and the Chinese domestic asset. And the capital account is closed capital account anyway. But things can change, and we are at the really beginning of that journey. And for the time being, but I think the investment, we can talk about that, but the practical implication for our investment is not practical at this point of time. And the U.S. dollar and the currency is still going to be driven by the drivers we have discussed before. Okay, Henrik, what do you think?
Well, it will take a long time, right? And anyway, one of the problems is that everyone else, to achieve something, they have to trust each other, right? And I think we are some ways away from that. So looking to the future, this is by drawing to the end of this, drawing to the close of this episode. So looking to the future, many people propose, obviously see that digital currencies will gain popularity. It's almost a historical inevitability, right? So how do you think about the impact of cryptocurrencies, if any? For example, it's entirely possible, even probable, that one day we'll see central bank digital currencies. In fact, the Chinese central bank, the People's Bank of China, has already started to test out an early version of the digital renminbi. Completely setting aside issues whether one is or should be or could be comfortable with such tools, do you have any thoughts on how a future digital dollar, launched and managed by the Federal Reserve, might impact the US dollar cycle? It sure would be an easy channel for distributing helicopter money again, if it ever came to that. Jim?
Yeah, Henrik. So you mentioned a lot of questions, okay? So I try to remember all of them and address them. And by the way, I am not an expert in the digital currency, so my knowledge and comments can be superficial. But here is how I look at it. The digital currency, people use it interchangeable for a lot of things. And as for cryptocurrency, it serves for a purpose where the cryptocurrency, I think they do have natural demand. And the reason for that is because of the decentralized nature. So the whole purpose of decentralized, in the currency is basically to eliminate the intermediary, right? so that they can conduct the transactions without being known, right? And because of that, there is a natural demand for that. Say, some capital, the usage, one of the usage can be to evade capital control. So you can also heard a lot of people, the drug dealers will use it, right? The war, criminals who want to, terrorists who want to evade the sanctions, then they may use cryptocurrency to evade the sanction, to evade the control, right? And obviously you can carry gold, right? But carrying physical bars of gold is very cumbersome and very difficult to do, and you can get caught, right? So that's why there will be natural demand for cryptocurrency, and where the supply and the demand is also not controlled by the central banks, right? It's not controlled by any specific entity, but rather than the computing power, right? Of that particular currency, that particular cryptocurrency. Obviously, you have a lot of different cryptocurrencies. But if you're talking about the central bank digital currency, and then that's different thing because it's not decentralized anymore. It's basically still going to be the currency where the supply and the demand is controlled by the central bank, is just in a digital format. And that is also different than the digital transaction, right? So if you think about digital currency as a digital transaction, then we already have it, right? Because we do not use, you need to use the paper, physical cash anymore. We use credit cards, we use the debit cards and or the phones, right? And electronic apps, right? So that is actually already here. Now the digital central bank digital currency, where is really the digital identity of the currency. Think about you have a physical, kind of a, dollar note where you have a serial number, right? And that can be basically have a digital identity that can be tracked by the central bank. So the central banks really know every dollar, where it goes, who, what the entire transaction, right? By the aggregate. And then they obviously know where's the demand and where's the spend and all the details of that. And I would say if you think that the people going to open a direct kind of account with the central bank, circumvent the entire banking system, and I think it is highly unlikely because the reason for the banking intermediary here is really for the commercial banks to make economic decisions on to allocate the capital. They need to assess when they make loans. They need to assess which loan is attractive versus their funding cost, right? Where that's not the job of the central bank. So I would say from that perspective, I do not think that we will go that route. And obviously, during the crisis, the central bank can do a lot of things, and like you said, the digital currency will enable them to basically, credit everyone's account, to hand it off the money, and that's more efficient than the banking system. Or for what other matters, just debit your account because they do not like the things that you were doing, right? And that would be a terrible thing to do. But we know the central bank is basically the lender of the last resort. Okay. They are not the spenders of the last resort. And when you make the central bank the spenders of the last resort, then we will be worse than Argentina, right? So I do not think that, although a lot of people talk about this, I do not think that is the way that we're going. However, I do think using the dollar for the digitalization of the currency transaction is a major trend, and how the central bank will use that digital identity per se. When I talk about digital identity per se and how to use it, I think that's a completely different matters to discuss. Okay. But anyway, I think it's remote enough for us to discuss for the practical implications of investment decisions.
Thank you, Jim. Very insightful. So we're now at the end of our third episode, and here are two concluding points, at least the way I see them. Currency movements can be analyzed just like assets, such as bonds, and observing the interdependence between changes in the values of currencies and changes in the values of other assets can give us valuable insights how the markets express expectations and how central banks react. The second point is that even if you do not trade currencies explicitly, understanding currencies and the US dollar cycle will help global investors allocate capital better. And even if you only trade domestic US assets, having insights into the dollar will strengthen or weaken, if the dollar will strengthen or weaken, can inform your valuation of domestic assets, and your assessment of the relative performance of domestic asset classes. So that's my takeaway. Jim?
Yeah, that's a great summary. Henrik, so tell us where the listeners can follow us.
Yes, absolutely. You can follow us by searching Total Convexity in your favorite podcast app or via YouTube. Please don't forget to click on the subscription button so that you will be automatically notified when a new episode is available. You can also follow us on X, what used to be Twitter, where we have the handle @TotalConvexity. And you can email us at totalconvexity@gmail.com. Finally, you can follow our insights on Substack at totalconvexity.substack.com. We promise never to spam your email box or to provide any sort of advertising or marketing, and we're not going to try and sell you anything. All we're giving you is our honest take on the markets, right or wrong, and we'll try and make it short and sweet. Anything else, Jim?
No, that's it. Thank you, everyone. If you like this podcast, we would appreciate if you can pass along to anyone who may be interested. This concludes the third episode of the podcast. See you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.